Canadian insolvency numbers just hit their highest level since 2009. Average non-mortgage debt is at $43,000 per household, and today, three of Canada's biggest lenders just reported their best quarter in years. Welcome to the Daily Brief Canadian Macro. I'm Steve. Today we're covering a busy Wednesday across Canadian markets. We've got bank earnings from BMO, Scotia, and National Bank, a major commodity update across energy and critical minerals, and a look at where the TSX closed and why. We heard from BNN Bloomberg's market coverage along with portfolio managers Grant White and Mike Bino on the banking sector. Let's get into it. Q2 earnings day for three of Canada's lenders, and all three beat estimates: BMO, Scotia, and National Bank. It is worth noting that while National Bank is not one of the big five, it is a significant Quebec-based lender and increasingly part of the national conversation. And all three topped analyst expectations, and all three raised their dividends. BMO posted the most dramatic surge with net income up 34% year over year to $2.63 billion. On an adjusted basis, EPS came in at $3.67, well ahead of the $3.45 consensus. Scotia reported adjusted EPS of $2.02 against a $1.93 estimate. National Bank rounded out the trio at $3.23 per share versus the $3.14 forecast. The analyst community is split on what to make of the valuations from here. Grant White's view is that National Bank remains a top pick, with strong wealth management, execution, and disciplined focus across business lines. He sees Scotia's elevated loan loss provisions as a sign of prudent management rather than economic stress, which actually moves it up his buy list. His structural thesis: BMO's U.S. banking exposure is an advantage that domestically focused peers can't replicate. Mike Bino reads the same numbers more cautiously. Dividend yields have compressed well below the historical 4 to 5% range, and Scotia is losing its valuation premium despite its international footprint, now trading at 11 times forward earnings, while BMO and National trade higher. The market reaction told a mixed story. Scotia rose 1.2%, BMO was flat, and National Bank slipped 2.7%, a classic sell the news reaction on the one that beat by the widest margin. It was a busy day across the commodity complex, and not all of it was green. On energy, the Canada-Germany LNG deal continues to advance. BC Premier David Eby confirmed today that the deal makes it more likely the Sleesims floating export project on the West Coast will proceed, capable of producing 12 million metric tons per year. Northern Oil and Gas also acquired a 25% stake in Calgary-based Parallax Energy for $350 million. Another sign that foreign capital is still finding Canadian energy assets attractive despite the macro noise. Aluminum hit a 4-year high above $3,600 per metric ton on fears that Chinese smelters will be ordered to cut production amid nationwide inspections. Those producers had been running beyond capacity to capitalize on global shortages tied to Middle East supply disruptions. That overhang is now a liability. On precious and critical minerals, gold was trading at $4,465 today, down about $49 on the session, while silver pulled back to $75.34, off about $2. Both remain in historically elevated territory. The geopolitical backdrop and Hormuz uncertainty are keeping a bid under safe haven assets generally. But today saw some profit taking. Copper eased from the $6.40 range it had been testing, still historically elevated but running into resistance as China demand signals stay mixed. The long-term copper thesis for Canadian investors remains intact: electrification, AI data center infrastructure, and a structural supply deficit that won't resolve quickly. Finally, uranium is worth flagging. Spot prices have been in the $85 to $99 range through 2026, supported by the same energy security theme driving the LNG story. Nuclear is back on the policy agenda. AI data center power demand is real, and Canada's Athabasca Basin holds some of the highest grade uranium deposits in the world. The domestic angle, diesel capacity being maxed out in Arctic settlements, nuclear infrastructure needed by 2030 for defense purposes, adds an urgency that doesn't get enough attention in the mainstream conversation. In taking a look at the market close, the TSX had a tough session despite the earnings beats. The index traded under modest pressure, with weakness in energy and materials dragging on the composite. Financials softened as investors reassessed interest rate expectations, and gold and base metal producers pulled back on weaker commodity pricing. In the broader context, Tuesday's session fell 0.5% as hopes for a Middle East resolution faded following fresh U.S. military strikes in Iran, renewing uncertainty over the Strait of Hormuz and keeping higher for longer rate concerns alive. Today's bank beats provided a floor but not a catalyst. The market is still working through what prolonged Hormuz disruption means for inflation and the Bank of Canada timing. The household finance picture underneath all this remains the real story. Insolvency numbers have hit their highest level since 2009. Average non-mortgage debt is at $43,000 per household. Mortgage delinquency balances rose 32% nationally year over year, but Ontario was up 52% and BC up 36%. Those are the exact markets where pandemic-era buyers are now hitting renewal at materially higher rates. The banks are beating earnings, the customers in some cases are not. Well, today's coverage points to a Canadian economy that is holding together at the institutional level while showing real stress at the household level. The banks beat, the analysts disagree on what the beats are worth, and the market's muted reaction suggests investors aren't convinced the good news is that durable. On commodities, Canada's positioning is genuinely strong. LNG deals with Germany, world-class uranium in the Athabasca Basin, copper and aluminum exposure at a moment when the energy transition and AI infrastructure are driving structural demand. The problem is that global uncertainty, particularly around the Middle East and Hormuz, is creating a risk-off tone that's weighing on the very resource stocks Canada depends on. The through line for Canadian investors, though, is that while the macro story is improving on paper, the transmission to household balance sheets is uneven, and the geopolitical noise is keeping a lid on the community upside that should be Canada's tailwind right now. Well, that brings us to the end of this evening's episode. Thanks for watching the Daily Brief. All credit goes to our sources featured today for their original analysis and insights. You can find links to their full videos in the description below. If you found this video helpful, please subscribe. Hit that notification bell so you don't miss our next brief, and don't hesitate to comment if there's a creator or topic you'd like to see covered here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.